Welcome to Morningstar. I'm Larissa Fernand, and with me today is Ian Cassel, an individual microcap full-time investor and the founder of MicroCapClub. Ian, thank you so much for being here today.
Thanks for having me. It's an honor to be here.
Ian, my first question to you was when you started off and you were a full-time individual investor, it was your money on the line. It was you bought the price of your convictions or your errors. How insecure did that make you feel as an investor? How did it shape or mold your behavior?
It's a good question. I was a full-time private investor from around 2009, kind of from the GFC, the global financial crisis, to about 2018, 2019, so about 10 years, and kind of leading up to that point, also kind of building capital to a point where I could do this full-time as a private investor. But there's certainly a lot of pressure. A lot of emotional pressure, when you make that leap. And it's certainly easier being a full-time private investor when you're young and single and your cost of living is next to nothing. But then you get married potentially, and I don't know how it is in India, but at least here in the US, when you get married, wives don't want you to rent. They want you to own the house they want to raise a family in. And then, kids, I don't know how it is in India, but kids here, it's not cheap to have children. And so the expenses keep increasing, and not only do your expenses start increasing, but the time constraints. If you want to be a good father, if you want to be a good husband, those relationships take time as well. And so instead of having 27 hours a day to research stocks and individual equities, you then have 15 hours a day, and then you have 9 hours a day, and so everything kind of just gets constrained. So, all this to say is like the pressures come from kind of everywhere when you're a private full-time investor, whether it's time or expenses. And then, you kind of layer on also, depending on what type of strategy you have. I'm a long only concentrated microcap investor. And, for most people, it sounds like I juggle dynamite for a living if I'm doing that. But, I'm just used to it. It's a very volatile portfolio, as you can imagine. And so you're trying not to let the pressures of life, of time, of expenses and your ability or inability to pay short-term bills while keeping a long-term focus, all of that kind of adds to the pressure of it. But, I think what's helped me kind of deal with the pressures when I was a private full-time investor was, kind of mainly living in a calm place. I live in Lancaster, Pennsylvania, and I'm sure many people don't know where that is, but it's a very rural type of environment, a lot of farms around this area. It's pretty low key. I'm not in a city, and also, if you eventually get married, it's important that who you surround yourself with, whether it's your spouse or whether it's your friends, are also kind of a calm demeanor. It's like what I do for a living is volatile enough. You don't want that, volatile relationships involved as well. So I think it's important to kind of set your lifestyle up, the friends and folks you have around you to support, the type of long-term objective you have for your, financial mindset as well as a private full-time investor. That's probably a little bit more than what you asked for, but that's kind of what just came off the top of my head.
But how did you deal with loss? Because all your bets would not have played out as you envisaged. How did the losses hit you?
I think one of the things you realize, unfortunately pretty quickly is, losses are a part of the investment process. And especially, you can't be a microcap investor and play for perfect, or you'll never pull the trigger on anything. And in fact, most big winners in microcap aren't perfect looking when you first buy them. That's the reason why, they're inefficiently priced or they're cheaply priced. They have some hair on them, they have some problems. And that's obviously where kind of the opportunity is. When you look to buy these things at a value type of price. I'm right on my investments for the right reasons. And I want to emphasize that, right for the right reasons, probably less than half the time. Right for the right reasons, less than half the time. I'm probably right for the wrong reasons, maybe another 10 or 20% of the time. And then I'm just plain wrong the other percent, And so I think a key distinction, to make, and that's worth mentioning is, losses and mistakes are two different things. If you invest in small emerging companies, you'll always have losses. In fact, I think if you aren't taking enough small losses over time, it means you're not taking enough risk. So just because you lost money on something also doesn't mean that you were wrong for making the investment. So the real issue is when, and I still do this unfortunately, but is when we turn losses into mistakes. And I think losses turn into mistakes when you didn't do enough of the work, you didn't do enough maintenance due diligence. Mistakes are sort of like unforced errors in tennis, where your actions or inactions turn small losses into larger losses. And those are the types of things that I like to rub my nose in, and just to remind myself, because I keep making mistakes, even though I've been doing this for 20 years.
You've always said that you love a good story, and that great management has a great story to tell, and stories sell a business, and you always were into stories. So how, especially in the microcap space, where you don't have much research on a stock, how do you make sure the story is not just a deluded narrative? There's just too much fluff. How do you find out a real story?
At least here in the United States, when we look at the microcap ecosystem, which is about half of all the companies that trade publicly here in North America, around, I think it's close to 85% of those companies are unprofitable. So I would lump those into the story stock companies. About 15% of them actually have a business that makes money. And what I like to do is focus on the 15% that actually make money, but also have a good story attached to it. When I mean a story, I don't mean the story is meant to deceive or embellish, a business. I'm talking about stories that are core kind of to the ethos of the business. I kind of think of it, to give sort of a similarity, I kind of think of it as kind of Aravind Eye Care or Dr. Govindappa Venkateswamy over there. It's kind of a story that excites people, that people can get behind, one that customers, employees, stockholders like naturally want to rally behind. I want to kind of, the way my strategy is, like I try to buy companies that are undervalued that can get overvalued. And the way a company gets overvalued is consistent execution, combined with a great story that connects with people.
You once mentioned that after a mediocre quarter, it's not good to instantly average down. You got to wait it out, because definitely another quarter would follow. But it sounded like a mistake you have already made. So how have your mistakes shaped you? What did you believe then that you no longer believe now, or vice versa?
I think that's a good question. I think when it comes to averaging down, I think it's something that's kind of easy to do because you already own it. You're kind of anchored to what the business used to be, and it just looks cheaper. But I kind of reframe averaging down as, if you were personally going to be lending someone money and you lent them money and then they repaid you back half, would you give that person more money? And obviously the answer would be, of course not. And yet we continually do that with our investing, where we average down into things that have a history of disappointing us. And I don't think averaging down, I can't broad brush the whole, action of averaging down is bad. It certainly is a good thing. But I think it's important to kind of disconnect, the business from the stock price, and only average down in stocks where the business is continuing to execute or the business is accelerating, because that's when you can kind of take advantage of why that stock is down. Just averaging down for averaging down purposes just never works out.
So what is something you believed a while back which you don't believe anymore? Like, say, when you started out to what you are today?
I would say when I first got started out, I actually started out as a story stock investor. And it was mainly because of the couple of mentors that I had were kind of focused on more of the story stock area of microcap investing. And I think one of the beliefs that I had early on, maybe in the first 5 or 10 years, was I really believed that management should spend maybe 30 to 50% of their time out telling the story to investors, out at investor conferences, doing investor roadshows, because, what's the point of being public if people don't know you exist, and that was kind of my belief system. And, that shifted probably a decade ago or more, where I realized that, really the key for management and the CEO is to create a business whose fundamentals attract the right investors to them. It's more of a pull process, less of a push process. Warren Buffett has that famous quote, you get the shareholders you deserve. And, I think that's probably the main area that I've shifted is in that regard to management and, really just focusing on the business instead of focusing on selling investors on their story.
You also said that one tends to overanalyze a stock when it's going down and underanalyze it when it's going up. So how did you mentally learn to disconnect between the business and the stock price? How did you bring yourself to that point?
The key is kind of obsessing over the right things, the right KPIs. I think that every business has kind of two or three main things to pay attention to. And, a lot of times obsession can be a good thing, but it can also be a bad thing. When you start obsessing over every little detail about a business, the things that don't matter. In fact, I think the risk to concentrate investors, which I am, I hold 10 stocks or less in my portfolio, is kind of overthinking your positions. And because it can make you more short term, you start thinking that obsessing about positions equals precision. And it doesn't work that way. The only thing you should be obsessing are those key drivers of the business, and also obsessing over what could kill your thesis. And, especially in microcap and small cap investing, reaction time is important. So the biggest asset, or the biggest thing that you should be doing, is continuously having that maintenance due diligence. Because a lot of times when stocks are dropping, you start overanalyzing every little single detail, and it kind of steals your courage to act on obvious opportunities that, if the stock wasn't dropping, you would have been buying 5 days ago. And so it's important to be self-aware about where you kind of sit on the emotional spectrum, and not let the stock price kind of pull the leash, to kind of use a person and a dog analogy, kind of pull you and take you where it wants to go.
What gives you a kick about microcaps? You haven't ventured into the large cap space. What attracts you to microcaps?
It started 20 years ago, and to date me, I'm 42 years old. So I just kind of started into microcaps when I was 21. And really what attracted me then is still what attracted me now. And back then I tell a story about, when I was in university and I was getting into microcap investing. I went to a conference up in New York City, which was a 3-hour bus ride away. I saw a company that I liked, and I saw they were presenting at a conference in New York, and I ended up calling the conference organizer, and they ended up saying that I could come because I lied and said I was with Cassel Capital, even though I was only like 19 years old or whatever I was. And so I ended up going to this conference, and I was able to weasel my way into a one-on-one meeting with the executive of the company, and spent 10 minutes talking about the business. And he was kind enough to spend that time with me. And I kind of left that meeting with my eyes as big as saucers, and I couldn't wait to go buy the stock, and I did. And that's kind of what started my love affair with microcap investing. And it really started with just the ability for an idiot like me back then to be able to sit across the table from a management team and ask them questions, and feel like I could get a qualitative edge or informational edge in that business because of that. And that's still the thing that excites me today. It's much easier for me to get access to companies and management teams, but I love the qualitative aspects of investing, because when it comes to microcap investing, the smaller the company, the more important management and leadership becomes. What
is the leadership trait that you really look out for?
Yeah, I mean, I think some of this is common sense in some regards. I'm really attracted to kind of serial winners. People that have done it before, that have built a small company into something large. I'm not normally attracted to management teams that, were the CEO or the C-suite of, a $10 billion company or a large company, because, to really be an effective microcap leader, you need to have entrepreneurial characteristics. The ability to grow something small into something that is maybe still small, but larger. And so those are the qualitative attributes I'm looking for, is just kind of serial winners, people that have done it before. And the common theme I see in microcap companies that ultimately become sustainable winners is kind of like these management teams that have done it before, bringing the team back together again. And you can tell, just by looking at their bios, looking at how they talk, how they operate, how they have skin in the game, that, they should be running a much larger business.
in this entire microcap space, opportunities aren't abounding, right? It's pretty risky. And this is where luck and skill conflate. How do you view this whole paradigm of luck and skill?
Luck's an interesting ingredient, I think, to everything, whether it's a company or whether it's investing. We recently had our MicroCapClub Leadership Summit, which was in Chicago about a month ago. And one of the presenters or speakers I had was a gentleman named Ryan Pape. And he was the CEO or is the CEO of a company called Expel, which trades over here. And he became the CEO of Expel when the stock was a 1 million market cap. And now it's around a $2 billion market cap. And, not only is that amazing because he not only did that, but he also bought stock when he joined the company at 4 cents a share when it was a 1 million market cap. But that's been 150,000% return. So a 1,500 bagger on the equity, only 7% dilution over 14 years, which is an equally astonishing feat when you think about that. And, I asked him about luck and he said that luck was definitely a key ingredient to their success. They were the right product with the right strategy, with the right brand at the right time, and you ask him, like, back then when he took over the company in 2009, he never thought that the company would get as big as it did, and so it's kind of interesting when you think about the visionary of the company, not even believing that it could get as big as it ever did, as quick as it ever did. And so I think luck is a key component to companies. I also think it's obviously key to investing as well. And I think it's also important for investors not to get too far out in front of their skis, to use a skiing term, meaning, we're all trying to find a 10 bagger or a 20 bagger or a 100 bagger. But, thinking about a business that way at the onset probably isn't the right way to find one. You first need to find a 10 bagger. You first need to find a business or a stock that can double, and all right, once it doubles, let's look out further and see if they can double again, another 2 or 3 years. And, but kind of getting back to luck, it's crazy when you think about as investors, doesn't matter what your strategy is, but you'll ultimately over a lifetime kind of pass on more winners than you ever let into the portfolio, which is kind of interesting when you think about that. And, the longer I invest, the more I realize that kind of only a fraction of stocks that are out there and only a fraction of winning stocks are kind of really meant for you, meaning, your past experience, your diligence, your temperament, timing, and yes, luck kind of all collide and create a situation where that situation is meant for you to build conviction in and few others at that point in time. And I think that's the interesting thing about luck when it comes to investing in stock picking.
Would you have considered yourself overall a very lucky investor? Have you encountered your share of luck?
I recently did a presentation and I talk about a gentleman named David Walsh, and he was an obscure figure. You can't find much on him. He's only done 2 interviews throughout the world, but he's now known as probably one of the largest, most successful professional bettors, so gamblers in the world. Him and his kind of syndicate place around 10 or $20 billion USD of bets globally on different things, from sports to elections to lotteries. It's very quantitative. And he talks about luck when it comes to his success. He said, when he runs into scientists, mathematicians that are just as intelligent, just as bright, that created similar models, betting models, quantitative models as he did, but they either weren't as successful or they completely failed. And he isn't any smarter than they are, but he says that a lot of his success was due to kind of luck and timing, the luck of some of those early successes and maybe the lack of early losses, early in his career, that kind of helped the trajectory of compounding kind of what he's built over time and the knowledge that he's built, not only his capital. And I think that's true of any type of super successful person, which I don't lump myself, because I know your question was about me, not him. But I think we all suffer from survivorship bias too when we look at folks that have built something big that are in the top 0.1% of their field, whether over here on the sports side, it's Michael Jordan or Tiger Woods, or whether it's Jeff Bezos or Warren Buffett or whatever. And we like to kind of look at what they've done in life and how they did it, and then extrapolate forward that that's all it takes to succeed, when in reality there was 10 million other people that probably had the same work ethic, that had the same skills, where luck and timing just didn't fall into place for them.
Right.
And so that's why I find luck interesting.
Interesting. And my last question to you is, if your children had to follow into your footsteps professionally, what would be the advice you'd impart to them?
Yeah. I think the one thing that you realize quick with kids is they don't do what we say, they do what we do. And I think the best thing I can do outside of just being there for my two kids, and I have a daughter and a son, an 8-year-old and a 5-year-old, Madeline and Jack. And I think the best thing I can do for them outside of just being there for them, which unfortunately in today's day and age is rare, but a very close second to that, I think, is it's important for my kids to see me living kind of my dreams, kind of living out, the life that I want to live, and kind of accomplishing my dreams. My kids are still young, like I said, 8 and 5. And so they don't know what they want to do in life, but I think whatever they do, whatever that is, that ends up being the dream that they want to pursue, whether that's being an astronaut, a farmer, a microcap investor, a social worker, whatever it is, that, I think it's important that they know that they can accomplish that. And I think the way my kids are going to know they can accomplish their dreams is because they will see me accomplishing mine. And I think outside of being there for them, I think that's the greatest gift I can give them. So I don't think too much about them becoming microcap investors, but I do think a lot about making sure that they know they can, do whatever they want to do in life.
That's fantastic. Ian, it was really, really good talking to you, and I thank you for your time.
Thank you. I enjoyed it.
Yeah. Have a lovely day. Bye-bye. This is Larissa for Morningstar. Thank you for watching.